Good morning and welcome to Bulls, Bears, and the Bell Morning Edition. We're here for your essential deep dive into what's really driving the market open. It's Monday, September 22nd, 2025, and things are looking, well, complex. Cautious, I'd say.
Definitely cautious.
Yeah.
See the headlines, right? Record highs from last week.
Exactly. That big Fed rate cut 25 basis points, just what the market wanted, sparked, total euphoria into the close last week.
Uh-huh. Pure celebration.
But here's the challenge, and this is our mission today. That feeling, it's gone, vanished. We need to dig past those index levels, figure out the real signals, the hidden risks.
Because there are serious headwinds now. A big policy shift hitting tech is front and center.
So we're going to connect the dots for you. It's this fascinating divergence, isn't it? Record stock prices, but underneath.
Underneath, you've got growing anxiety, real defensive moves happening. We see it in the data. The macro picture is flashing risk off.
It totally contradicts the indices. That's exactly it. We'll show you where the money's actually moving, why this rally feels maybe a bit fragile, and how this IT policy shock could really test things.
Okay, so the mood right now. Futures are flat to slightly negative. Dow futures down about 0.3%, around 46,524.
S&P 500 futures off maybe 0.2%, sitting at 6,707.
And even the Nasdaq 100, the leader, it's just hovering near its highs, barely moving, feels like exhaustion.
Yeah, peak exhaustion maybe.
All right, let's unpack this. Why did that post-Fed rally just fizzle out globally? So when we see U.S. futures acting like this, kind of subdued after a big Fed move, it tells you something important about how fast markets work, doesn't it?
Absolutely. It means that whole 25 basis point cut, the good news we cheered last Friday. Yeah. It's already baked in, completely priced. Done.
The market's already moved on.
Instantly. Once the news is out, traders stop looking back. They pivot straight to the next thing, the new risks, the headwinds.
So this pause this morning, this flatness.
It's a signal. The lift from the cut is over. Now everyone's laser focused on the new stuff, especially that domestic policy hit on tech we need to get into.
And crucially, there's no help coming from overseas, right? The global markets aren't joining hands in some big rally.
No, it's really fragmented out there. No unified tailwind for the U.S. at all.
What did we see in Asia overnight?
Well, it was a real mix. You had Japan's Nikkei 225 up strongly, like 1.42%.
Okay, that sounds good.
But hold on, that was very specific, very domestic. It was all about the Bank of Japan clarifying its plans for selling off its huge ETF holdings.
Ah, so it wasn't about global growth or anything?
Not at all. It was relief for Japanese banks, a local policy thing. Definitely not a sign of broad global confidence.
Got it. So, Nikkei aside, what about the rest?
Elsewhere, you really feel the caution, and it connects right back to U.S. worries. Hong Kong's Hang Seng down sharply, fell 1%.
Okay.
And India equities opened lower there, and that was a direct hit from this U.S. policy news affecting their big IT firms. They're already reacting before we even open here.
Wow, okay. And Europe?
Similar story, mirroring the caution. Germany's DAX was down about 0.6% in early trading. France's CAC 40 slipped a bit too.
They have their own issues too, I suppose. Energy, geopolitics.
Exactly. And you see that reflected in crude oil prices ticking up. But the main point for you listening is this. The U.S. market is facing its own domestic pressures today, like this policy shock.
And it can't count on a global wave to lift it up.
Nope. It's kind of standing on its own this morning. Makes those vulnerabilities feel a bit more real, doesn't it?
It really does. Okay, let's talk about that contradiction. The record highs versus all this defensive action.
Right. So to get why the smart money seems anxious, even with indices at records, you absolutely have to look at the macro signals. They're screaming risk off. It just doesn't match the stock headlines.
Where do we start? Gold.
Gold's the classic. It's holding really firm near that recent record high, around $3,695, $3,696 an ounce.
That's significant.
It's not random. That's real money actively hedging. Hedging against inflation worries, against policy uncertainty, against, geopolitical messiness.
So big investors don't fully trust the stability implied by these stock prices.
Not entirely. They're buying insurance, basically, preparing for potential bumps down the road.
Okay, what else? Crude oil's creeping up too, you mentioned. WTI around $63.08.
Yeah, inching higher. And that's supported by those geopolitical tensions, Middle East, Eastern Europe. That risk gets priced into energy.
Which feeds back into inflation fears, of course.
Exactly. And then there's the dollar. If gold is the hedge, the U.S. dollar is often the ultimate safe harbor currency.
And it's been strong.
Very firm. The dollar index is around 97.75.
Yeah.
It's 4 straight days of gains. It shows global capital pulling back from riskier places, seeking safety in dollar assets. It's a classic flight to quality,
When in doubt, buy dollars.
pretty much. Even the bond market is flashing caution.
Right. You'd think after a Fed cut, bond yields would drop sharply, signaling confidence. But the 10-year Treasury yield is actually up a tiny bit, around 4.14%. What gives?
It tells you the bond folks, who are usually the most cautious group, are still worried. Maybe they think inflation sticks around. Maybe they think the Fed can't cut as much as the stock market hopes.
So they're not buying the all-clear signal just yet.
Definitely not. That slightly higher yield, instead of a plunge, is pure skepticism priced into bonds.
Okay, this is where it gets really interesting for me. This external caution, this defensiveness, it's mirrored inside the market itself, right, in the structure.
Yes, and this points to a huge vulnerability. Weak market breadth.
Explain market breadth for us again.
Think of it like a health check for the whole market rally. Are lots of stocks participating, or just a few?
And the numbers right now are?
They're frankly alarming. Only 55% of S&P 500 stocks are trading above their 50-day moving average. 55%.
Wow, and compare that to earlier.
In the summer, that number was closer to 80%. So the big drop-off in participation.
So if the index is hitting records, but barely half the stocks are actually doing well, what does that mean? Like, is the party really roaring or just a few big names dancing?
That's a perfect analogy. The index level looks like a great party, but only, say, 7 superstar stocks are really carrying the whole thing. Everyone else is sort of standing by the walls looking nervous.
The Magnificent Seven effect.
Exactly. Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla. Their sheer size means they can drag the index up, even if most other stocks, the other 493 in the S&P 500, are flat or even falling.
That sounds fragile.
It's incredibly fragile, highly top-heavy. In a healthy market, you want 70%, 80% participation. At 55%, the internal strength just isn't there.
So if one or two of those giants stumble,
The whole market could take a disproportionately large hit because there's no broad strength underneath to cushion the blow. It's systemic risk hidden behind a shiny headline number.
which brings us directly to the policy shock that could potentially trip up some of those leaders, or at least their ecosystem. Okay, let's zero in on this policy move. It seems to be the biggest single driver of negative sentiment today, especially for anything tech-related. We're talking about the new H-1B visa fee hike.
Yeah, and this isn't just some minor adjustment. It's a policy bomb aimed right at the business model of a huge part of the global tech services industry.
What's the specific change?
The administration has imposed a new one-time fee of $100,000 for each new H-1B visa application.
$100,000 per person.
Per new H-1B hire. Now, it's one time, but if your whole business relies on bringing in hundreds or thousands of these workers,
Yeah.
the total cost becomes astronomical, fast.
Okay, 100 grand. That's not just pocket change. That fundamentally attacks the core model of many big IT services firms, especially the India-based giants, right? The whole idea of labor arbitrage.
Exactly. Labor arbitrage is using skilled workers, often from overseas via H-1B, to do work for U.S. clients much cheaper than hiring locally. Companies like Infosys, TCS, Wipro built empires on this. Their profit margins depend on that cost difference.
So if the cost getting that worker just jumped by $100 K up front, what does that do to the math?
It potentially destroys the economics for a lot of roles. Imagine you contract out a worker, planning to make a decent margin over a few years. Slapping $100,000 on day one, that margin disappears, maybe even goes negative initially.
So these firms face a horrible choice.
It's a brutal choice. Either they eat the cost and watch their margins get crushed, potentially by double-digit percentages, or they try to pass that massive cost onto their American clients.
Which is risky. Clients might just say no thanks and go to a US-based competitor who doesn't have this H-1B dependency.
That's the competitive shift right there.
Yeah.
And we're seeing it hit the stocks already. Those big Indian IT names are looking at sharp drops at the open, maybe 2% to 4% down. The market sees their future profitability shrinking instantly.
So advantage US consulting firms, maybe?
Potentially, yes.
Right.
But the really huge long-term impact here, this could be a massive accelerator for automation and AI.
Ah, okay. Explain that connection.
Well, think about it. If skilled human labor suddenly costs $100,000 more right off the bat, what does that do to the appeal of investing in AI or automation software that can do some of those same tasks?
It makes the software look a lot cheaper, relatively speaking.
Overwhelmingly compelling in many cases. This policy effectively puts a giant penalty on using certain human labor, which creates a powerful incentive to replace it with technology.
So IT departments that were maybe considering AI for customer service or routine coding or QA.
Now they have a $100,000 reason per hire to push those projects to the front burner. That cost-benefit analysis just got radically tilted towards automation. This policy, maybe unintentionally, could end up being a huge shot in the arm for the AI software industry, creating structural demand.
That's a really key point. If money is rotating out of these IT service firms, it has to go somewhere. Let's look at where there is positive momentum.
Good idea. Because we are seeing strength elsewhere, in sectors tied more to the U.S. economy or benefiting from that Fed cut, logistics, for example, FedEx looks set to continue its good run after beating earnings.
What drove their beat?
Strong U.S. shipping volumes, they said, plus good cost control. Decent shipping volumes usually mean broader business activity is holding up okay.
And the housing sector seems to be loving the lower rate outlook.
Oh, absolutely.
Yeah.
Housing stocks are clear outperformers today. That Fed cut helped push mortgage rates down a bit, improving affordability, even if just slightly.
So builders like D.R. Horton, KB Home, Toll Brothers are up.
Seeing nice gains. And that flows through to the retailers, too, like Lowe's and Home Depot.
Mm.
The market expects maybe more home buying, more renovation activity. Housing is definitely a direct beneficiary of last week's Fed move.
Okay, and one other pocket of strength, this one more specific, the Adani Group in India.
Yeah, that's a big turnaround story boosting sentiment over there. Indian regulators basically cleared them of those Hindenburg allegations from 2023 about stock manipulation.
So, clean slate.
Pretty much. Analysts are rushing to upgrade targets, talking about value unlocking. It's a nice confidence boost for the Indian market, helping offset some of that IT gloom.
Interesting how these specific stories play out. Okay, let's talk about this weird split in the market, the cautious big money versus, well, something else entirely.
Yeah, it's a stark contrast. We've laid out the institutional caution gold, dollar strengths, poor breath, defensive positioning. But then you glance at the pre-market biggest movers list.
And it's like a completely different planet. Pure speculation, total volatility.
It's this extreme bifurcation, big money hedging, while another pool of capital is chasing absolute lottery tickets. It says a lot about the current environment.
Today's flavor seems to be crypto, blockchain, companies suddenly creating Bitcoin treasuries. It feels very narrative-driven, almost zero connection to fundamentals.
Totally. Look at AGM Group Holdings, AGMH. It's up over 200%, 212% last check to nearly $7.
On what news?
Unspecified major news. We don't even know what it is yet. The stock tripled just on the rumor of news. That's pure, unadulterated speculation.
Wow. And the volumes are insane, too. Chijet Motor Company, CJET.
Unbelievable. Up 81%, trading at like $1.18, but on nearly 400 million shares traded pre-market. 390 million.
What's the story there?
They appointed a blockchain veteran as COO to sort out their crypto treasury. Just using the words blockchain and crypto treasury is enough to ignite that kind of frenzy in these low-price stocks.
Same pattern with ZOZ Power, ZOZ.
Yep, rallying almost 100% after shareholders okayed a plan to create a Bitcoin treasury reserve. It's all about the buzzwords.
So what does this tell us while institutions are worried about systemic risk?
You have this segment of likely retail, capital completely detached, chasing momentum and narratives in these highly risky microcaps. They're ignoring the macro picture, ignoring geopolitics, ignoring everything we just discussed.
It feels unstable.
It's incredibly unstable. This frenzy in low-float names might create some buzz, but it does absolutely nothing to fix the underlying top-heavy structure of the main indices. It's a distraction, not a solution.
Okay, let's pivot back to the stocks that actually built this rally. The mega caps.
Right.
We're seeing some modest selling, some profit-taking there, like Intel.
Yeah, Intel, INTC is down maybe 0.8%. Not a huge drop,
Yeah.
especially after it surged, 22% last week on that NVIDIA news?
Right.
So this slight dip down to around $30.34 feels like the market shifting gears, moving from the initial excitement about the NVIDIA investment and partnership.
We're thinking about the hard part.
Exactly, thinking about the execution risk. How hard is it actually going to be to make this partnership work? How much capital will it really take? How long until it actually boosts profits? It's digesting the news, not panicking.
And Adobe, ADBE, is still struggling, isn't it? Even after recording record revenue. It's down like 20% this year still.
It is. Adobe's situation is really interesting. Record revenue driven by their AI stuff sounds great, but Wall Street seems increasingly worried about competition. Are new AI native companies going to chip away at Adobe's dominance in creative software? The market seems cautious, wondering if Adobe's AI growth can keep pace with the threats and maintain its high valuation.
So even good news isn't enough sometimes if the competitive landscape looks scary.
Precisely. It's all about future expectations.
Okay, looking ahead. What's on tap for earnings and analyst views?
Well, today itself is pretty light on the earnings front, at least in terms of big market movers. Before the bell, we got Marty Technologies, NS Inc., Uxin Limited,
Okay.
and after the close, Firefly Aerospace and Spire Global. Important for those companies, obviously, but they won't set the tone for the whole market.
But the market's already looking past today, isn't it? There's one earnings report this week everyone in tech is watching, Micron.
Micron Technology,
Yeah.
MU.
Yes.
That's basically the systemic event for the semiconductor space this week.
Why is Micron so crucial?
Because they make memory chips, DRAM, and NAND. Their results, but even more importantly, their guidance for the future.
Yeah.
It gives you a direct window into demand across huge parts of the economy. Consumer electronics phones, PCs, and the really big one right now, the high-performance servers powering the whole AI revolution.
So if Micron comes out and says demand for AI server memory is booming, outlook is fantastic.
That validates the whole bullish AI investment story.
Yeah.
Big relief, probably lifts the whole sector.
But if they signal any weakness, maybe consumers aren't buying phones or companies are pausing server upgrades.
Uh-oh. Yeah, any hint of weakness, any cautious guidance could send shivers through the entire tech supply chain. It could confirm all those underlying anxieties we've been talking about and trigger a serious sell-off. Micron's report has the power to really shift sentiment this week.
Definitely want to watch. What about analyst actions? Any interesting upgrades or downgrade signaling shifts?
Yeah, a couple interesting ones, especially regarding Chinese stocks, the ADRs. Baidu, BIDU, got a big upgrade from sell all the way to buy at Arete with a $143 target.
And NIO too?
NIO, the EV maker, upgraded from neutral to buy at UBS, target $8.50.
What's the significance there? Chinese stocks have been hammered by regulatory fears for ages.
That's exactly it. These upgrades suggest some analysts are starting to think maybe the worst of the regulatory crackdowns, both in China and the U.S., is over, that maybe valuations have gotten low enough to represent an opportunity, assuming policy stabilizes. It's a potential sentiment shift, albeit a tentative one.
Okay, what about downgrades?
More focused on traditional media and apparel, Warner Bros. Discovery, WBD, was cut from buy to hold. And VF Corp, they own Vans, North Face, Timberland, also cut from buy to hold.
What's the read-through there?
Continued pressure. For WBD, it's the ongoing struggle to make streaming profitable while managing a lot of debt. For VFC, it's just a tough retail environment, consumers being picky, lots of discounting. Signals caution about consumer spending.
And finally, Bernstein started covering a couple of giants.
Yeah, new coverage on Apple, AAPL, and Dell, DEL. Both initiated with outperform ratings and pretty bullish price targets, $290 for Apple, $175 for Dell.
So despite near-term worries, some analysts are still very positive long-term on hardware spending.
Exactly. It reinforces that view that the big long-term trend of companies spending on tech upgrades, and especially AI infrastructure, is still intact. They see companies like Apple and Dell benefiting significantly from that down the road.
Okay, so a mix of near-term caution and long-term optimism there. Let's turn to the big macro event for today, the Fed speakers, right? The economic data calendar is pretty empty today, so all eyes inevitably turn to the Fed this afternoon, don't they?
Absolutely. This becomes the main event, the key macro catalyst for the rest of the day. And it's critical because of that gap we talked about.
The gap between what the market expects and what the Fed is signaling.
Precisely. The market got really excited by the rate cut last week, maybe too excited. Right now, futures markets are pricing in way more rate cuts coming down the pike than the Fed's own projections, the famous dot plot, actually suggest.
That sounds like a recipe for disappointment.
It's a vulnerability. If the market expects, say, 3 more cuts, and the Fed is thinking maybe 1 or 2, that disconnect creates risk.
And we've got quite a lineup of speakers today.
We do. 3 voting members, which makes their words carry weight. New York Fed President John Williams at 1:45 p.m. Eastern, then Fed Governor Adriana Kugler at 2:00 p.m., and Richmond Fed President Thomas Barkin wraps it up at 4:00 p.m.
So the market's going to be hanging on every word. What are they listening for?
They're listening for the tone. Any hint of hawkishness, any pushback against the market's enthusiasm. For example, if Williams or Kugler talk a lot about inflation still being sticky,
Yeah.
or if they emphasize that future cuts aren't guaranteed, that they totally depend on incoming data, That would sound hawkish relative to current market pricing.
And that could spook investors, especially given how fragile the market feels underneath.
Exactly. If the Fed tries to gently walk back some of the market's more aggressive expectations, it could easily trigger selling. They have to be really careful with their language today.
Manage expectations without causing a panic. Tricky.
Very tricky, especially with no major data release today to distract or guide the narrative. It's all about the Fed speak this afternoon.
Okay, and looking beyond today, what data points this week will help clarify whether the market or the Fed is right about the path forward?
This week is packed with crucial data. We get the PCE inflation reading.
The Fed's preferred measure, right?
That's the one. Personal consumption expenditures. It's broader than CPI. If PCE comes in hot, it makes the Fed look right to be cautious about future cuts.
What else?
We get the flash PMIs, the purchasing managers' indices for manufacturing and services. Those are really timely reads on business activity. Are things speeding up or slowing down? That feeds directly into the Fed debate.
And housing data continues to be important.
Very important. We get existing home sales tomorrow, new home sales Wednesday. That'll show us if that recent dip in mortgage rates actually gave the housing market a meaningful boost or not. Lots of data to chew on after today.
Definitely a busy week ahead. Okay, let's try to synthesize all this. Hashtag tag outro.
So pulling it all together from our deep dive. What you see is a market that looks strong on the surface, those record indices, but the foundations feel increasingly shaky.
Right, the concentration in just a few mega caps is masking weakness underneath.
Exactly. And institutional money knows it. They're hedging look at gold, the dollar, the cautious bond yields. And that internal market breadth is poor.
So the market's resilience is really being tested today.
Severely tested. First, by this H-1B policy shock causing forced rotation out of IT services. And second, by whatever tone the Fed officials strike this afternoon. Those are the immediate pressure points.
It really feels like a critical moment for the market structure. We see the defensive plays, the weak breadth. So the big question, I think, for you, the listener, is this. Can that extreme concentration in the Magnificent Seven, or whatever we call the top stocks now, truly shield the entire market from a real correction, especially when faced with policy shocks and macro worries?
Is that narrow leadership strong enough?
Yeah. It feels like the last line of defense, and it's under real pressure today. Okay, that's where we'll wrap up our deep dive for this Monday morning. Thanks for joining us to get the full picture before the bell.
And maybe one final thought to leave you with as you watch the markets today. Think about that stark split we discussed. You've got institutional money buying gold, hedging downside risk. At the same time, you have speculative money chasing crypto narratives in microcaps.
Two totally different worlds.
Completely. So, in a top-heavy, fragmented market like this, which side usually wins out? Which direction does the overall market ultimately follow? And maybe consider this too. The sectors that are showing strength, like housing, seem totally dependent on interest rates staying low or going lower. How sustainable is that foundation if inflation proves sticky? Something to chew on.